This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on breakouts. In this video, I'm going to be talking about failed breakouts and how they can lead either to trend resumption or a trend reversal. Remember, a breakout is simply a trend bar. It can be 2 or 3 trend bars, it could be 10 trend bars, but a breakout is simply a trend bar. Here we have a breakout that lasted 3 bars. We have 3 consecutive bull trend bars. And then we have an attempt at a failed breakout. We have a bear bar closing on its low, and the bears are trying to end the breakout. They want the market to reverse back down. If this failed breakout fails to stop the trend, then you get trend resumption up. And that was the case here. We have a bull breakout, an attempt at failure, but the failure failed. So you have a failed bull breakout, yet it became a bull flag and the bull trend resumed. We have another bull breakout here. We have a bull bar, a bull trend bar, so it's a breakout. We have consecutive bull trend bars. So the consecutive bull trend bars created an even bigger breakout. We had a 1-bar breakout, and now it became a 2-bar breakout. And it's followed by a bear bar. The bears are trying to get the bull breakout to fail and reverse. In this particular case, the failed bull breakout, so we have a bull breakout, it's failing, it led to a trend reversal down. Remember, we had a bull breakout here, a failure, yet it was followed by trend resumption up. Here, we have a failed breakout, and it was followed by trend reversal down. We have a bear channel, so a bull flag. It's about a 50% pullback of this initial rally. And we have a bull breakout. We have a bull bar here, so it's a breakout, and the breakout extended for another 5 bars. So you can say the 6-bar rally is a 6-bar bull breakout. And then here, we're in a bull trend, and we broke below a bull flag, and we broke below a bull channel. We have a bear breakout. 4 consecutive bear bars. None is especially big. This is pretty good. We have consecutive bear bars here, and then a doji. It's a breakout, but not particularly strong. Remember, every trend bar is a breakout, and every bar with a prominent tail is a failed breakout. Almost every bar on every chart is either a breakout, a failed breakout, a reversal, or a breakout pullback, a flag. Bull breakout, and the bears tried to reverse. Their reversal failed, and it became a bull flag, and it was followed by trend resumption up. Traders will bet the breakout is strong enough, the context good enough, a 50% pullback in a bull trend. Micro double bottom down on that bear bar, and then up and down on that bear bar. So bulls will look to buy a breakout above that micro double bottom. The neckline is the bull bar here, so they'll buy above the bull bar. It's the same price as buying above that bear bar. In either case, they're going to be buying with a stop. Maybe they'll buy the close of that bull bar. Maybe they'll buy 1 pip above the high of that bull bar. In any case, they're viewing this attempt at a failed bull breakout as a bull flag, and they're buying as it reverses up, betting that the bull trend will resume. Here we have a bear breakout, an attempt at a failure, bear breakout. Bulls are hoping to create a failed bear breakout, about a 50% pullback from the bull trend, maybe a breakout test of these highs. We have a high, we broke above it, and now we're pulling back, testing it. The bulls are hoping that this bear breakout will fail and reverse up. Bears are hoping the opposite. They're hoping that the bear breakout will succeed and lead to a measured move down, or at least low enough down to make a profit. We tried to reverse up. The bulls are trying to make the bear breakout fail. The bears are betting the bear breakout will be successful. They'll place stop orders to go short just below the low of the prior bar, and they would be filled right here. And they did get enough down for at least a scalp. Every trend bar is a breakout. Every series of trend bars is a breakout. A breakout can be a single bar, and it can be a series of bars. Here, we have a pair of consecutive very big bear trend bars. You can say the breakout began there, but I think the breakout began here. I would view this as a 2-bar bear breakout, yet it's a 5-bar bear microchannel, 5 bars down without a pullback. It's a strong bear breakout. The bulls are giving up. Bulls are selling out of their longs, and bears are selling into shorts. Strong bear breakout. You have trapped bulls who have not yet exited their longs. They're hoping for any kind of a pullback so they can get out with a smaller loss. You have bears who saw this happening but for whatever reason, did not short and they're trapped out, they're looking for any kind of a pullback so that they can short at a higher price. We have a reversal, bear breakout, and an attempt at a failed bear breakout. But look at the reversal attempt. A lot of bars with small bodies, prominent tails, and a lack of consecutive big bull bars. We have a pair of bull bars here, consecutive, but small compared to the bear breakout bars. So this is probably a minor reversal, which means either a bear leg in a trading range or a bear flag. And in either case, you'll expect at least a small second leg down. Here we got trend resumption down, not simply a dip in a trading range. So this became a bear flag in a trading range instead of a bull leg in a trading range. This rally is mostly from bears taking profits, trying to reduce their risk. So if they short, their stop is now far away, and the best way to reduce that risk is by reducing their position size. So you have bears buying back part of their position, taking partial profits. Whenever I see a breakout, we have a bull breakout, and then I see a reversal, a failed breakout, I'm always comparing the strength of the breakout and the reversal. Here, we don't have much information, so maybe we have to look at some additional bars. We have a weak breakout up and a fairly weak breakout down. We have a bear bar, but a doji follow-through bar, and it's still a higher low. Bull breakout, but no consecutive big bull bars closing on their highs. We have a bear breakout, but no consecutive big bear bars closing on their lows. Bad follow-through. The bulls have a breakout, but look what it's followed by. And we have a bear breakout, and look what follows the bear breakout. A lot of overlap, and gaps are filled immediately or pretty quickly. Gap, this closed that high. Tried to get a gap here, but could not close above that bar. Whenever a situation like this is unclear, bull breakout, possible reversal, possible bull flag, things are unclear, usually that means sideways, usually better to wait. Wait for more bars, wait for more information. Here, bull breakout, bear breakout, big up, big down, actually a small version of it, leads to big confusion and sideways. This is bad context for taking trades. The range is so tight, very difficult to make money, even for scalping, even with limit orders. There's no significant buying or selling pressure. Alternating bull and bear bars, prominent tails, small bodies, lots of little dojis, a very tight trading range, better not to trade. Is one side clearly stronger here? Are the bulls clearly stronger? It's still lower highs. Are the bears clearly stronger? No. If one side is clearly stronger, then that increases the chances that that side will win and will get a breakout in that direction. At this point, is it still unclear, or is one side clearly stronger? The bears have a bear bar closing on its low. It's a big bear bar. It closed below the low of the past 20 or 30 bars. The bears are clearly stronger. The odds are we're going at least a little bit lower. We have 3 consecutive bear bars, a very big bear bar closing far below the lows of all the prior bars. Odds are 60% chance this bar will result in some kind of a measured move down. So chances are we're going lower. And that's why the bar looks like this. Everyone saw it as it was forming. It was becoming a big bear bar, and traders were selling, betting that it would go lower quickly. It might pull back, but it may simply go straight down. So a lot of traders were willing to sell right away just in case there is no pullback. Good context for a breakout, a successful breakout. We're in a tight trading range. We're in breakout mode. One side is probably going to win. And then we got a bar, a huge bar, big gap between the close of the bar and the low of the prior bar, the close of the bar and the low of the past 30 bars. Lower prices are likely. The bears are clearly stronger. Bear breakout, and look what followed. Good follow through, big bear bar closing on its low. That increases the chances that we're going lower. Now we have 4 consecutive bear bars, all closing on or near their lows. Chances are the first pullback, traders will sell it and will get at least one more leg down. Bulls are hoping for any kind of a pullback so they can sell out of their losing longs. Bears are hoping for any kind of pullback so they can sell at a higher price. Strong breakout like this probably will result in at least a measured move down from the open of the first bar of the breakout to the close of the final bar. We may get other bars in this breakout, but at this point, this is the final bar of the breakout. And you can see we fell for about a measured move down from the open of this bar, close of that bar. Again, tight trading range, very big bear breakout, fairly prominent tail, but a close below the low of the prior bar, close below the low of the past 10 or 20 bars. Traders need follow-through. It's possible that this is simply a trap that will reverse immediately up. Big bear breakout need follow-through. The bears prefer to get it on the very next bar, but sometimes it doesn't come in the next bar. Sometimes you'll get a rally for several bars, 5 bars, 10 bars, into a bear flag, and then you get the second leg down. If you do not get follow-through selling fairly soon, the market can reverse up. If you go sideways for 10 bars, 20 bars, the probability of the bears getting a second leg down drops. And after about 20 bars, the probability of a second leg down becomes the same as the probability of a reversal up. The market becomes neutral. Maybe after 10 bars, maybe after 20 bars. At some point, it becomes neutral again. Look at this. We have a great bear bar, but look what followed. If this was a trading range day or a broad bear channel, traders would look at this and say, it's a second leg trap. I'm going to buy above the high of this big bull bar, betting that this is just a trap, trapping traders into selling low. At this point, we have big down, big up, confusion, big confusion. You have to assume sideways, and then the market is in breakout mode. At this point, we totally reversed the bear breakout, and we went sideways. So even though it's only about 10 bars, I think the market's completely neutral. 50% chance the next move will be up, 50% chance the next move will be down. The bears gave up. It's a failed bear breakout. This bull bar, to me, means it's a failed bear breakout. This bar going above that bar confirms the failure. Failed bear breakout does not mean bull trend. It just means the bear trend has ended, and now the market is neutral. In this particular case, it did lead to a reversal. Bear breakout, very strong. Bull breakout, equally strong. Market is neutral. And we entered a triangle, and then we got a bull breakout. Possibly the start of a bull trend. Here, we have a pretty strong bear trend, lasted about 20 bars, very tight channel. We're getting a bull breakout. Usually, if you get a bull breakout above a very tight bear channel, the first reversal up is minor. Usually the market has to go up 5 or 10 bars, and then the trend resumes. If the bulls at that point can reverse it up a second time, some kind of a double bottom, maybe slightly higher, maybe slightly lower, they create a major trend reversal, a major reversal. But at this point, the odds are this reversal will be minor. Usually the first breakout above a protracted bear channel, a tight bear channel that lasts a lot of bars, is minor. The bulls have a micro double bottom, they have a possible 1 bar final flag, and they have a big bull bar closing on its high above the high of the past 6 bars. All good for the bulls, yet probably minor. Minor means the first reversal up probably will not get very far. So what happens? Bears will look at that and say, we got a strong bull bar, but it's probably a minor reversal. It probably will fail around the moving average. I'm going to sell the close of that bull bar, betting that it's going to be a failed bull breakout. That is a logical thing to do. More likely a minor reversal and a trading range or bear flag than the start of a bull trend. Not much risk selling a strong bull close at or near the moving average, betting the bull reversal will fail, because it probably will. Other traders will say, okay, I don't want to sell a big bull bar, but we have a bull breakout with a bear bar closing on its low. I will sell below the low of that bear bar, betting that the bull breakout is failing and that it's a 2-bar bear flag and the bear trend will probably resume. We're reversing up again here. This is a second reversal up, so it's a double bottom. I know this low is far below that low, but it's still a type of a double bottom and possibly a major trend reversal. I said this reversal, first reversal from a tight channel, minor, but that if we do get a resumption of the trend down and then another reversal, that could be major and lead to a change in the direction of the trend. The major trend is down, and now the bulls have a chance of turning the trend into up. Here we have 4 consecutive bull bars, and 2 of them are very big. 2 of them are closing on or near their highs. In fact, this is closing near its high as well. This is a strong enough reversal so that probably at least a little bit more up is likely, maybe a measured move up. Also, the context is good. It's a double bottom after a pretty good breakout above a very tight channel. So this could be a lower low major trend reversal leading to a major reversal of the trend. A major bear trend, maybe the start of a major bull trend. At this point, we're still getting lower highs. So we're still in a broad bear channel. But this is a pretty strong reversal. following fairly closely after this bull reversal, it increases the chances that we're going higher. The overall bear channel still fairly tight, not too many bars up, possibly still a minor reversal. In fact, it did become a reversal. You want to call it major, you want to call it minor. It was enough for traders to make a swing trade. I would call it a major reversal, but not enough to get above the top of the bear trend. And what we got was ultimately a trading range. At this point, after this much of a reversal, traders will look at the next reversal up as a major trend reversal. Is it a higher low major trend reversal? With 5 consecutive bear bars, probably not. It's probably more big up, big down, big confusion, and sideways. However, here we have a double bottom, slightly lower low, double bottom, a micro double bottom. This has a better chance of becoming a higher low major trend reversal. In this video, I talked about failed breakouts and how they can become flags and lead to trend resumption, or they can lead to a reversal. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on breakouts. I'm going to begin by talking about 5 tick traps and 11 pip traps, where the market goes almost far enough for a scalp and then reverses. Finally, I'll talk about fading weak setups. E-mini traders, the scalpers, they often take profits at 1 point, or 2 points profit, or 3 points profit, 4 points profit. 1 point is 4 ticks. 4 points profit is 16 ticks. That means that any move that is 4 ticks, 8 ticks, 12 ticks, or 16 ticks creates support and resistance. For example, if a bull buys above the high of this bar, looking for a scalp, a 1-point scalp, he buys 1 tick above, he places a limit order to sell 4 ticks above that, so that's now 5 ticks above this bar. That limit order probably will not be filled unless the market goes 6 ticks above this high. For the bulls to make a 1-point scalp, the market usually has to go 6 ticks above the high of this bar, and it did. This is 6 ticks above that, so bull scalpers were able to make a profit, a 1-point profit. If a bull's trying to make a 2-point profit, the market usually has to go 10 ticks. If he wants a 3-point profit, usually has to go 14 ticks. If he's expecting a 4-point profit, the market has to go 18 ticks. And that means 18 ticks above a reasonable buy signal bar, there is resistance. Bulls will be selling there to take profits. If the market goes 1 tick less than these targets and starts to reverse, then those scalpers are trapped. So for example, if it goes 5 ticks instead of 6 ticks and starts to reverse, the bulls were unable to get their 1-point profit, and now they're trapped, and a lot of them will start to sell. Let's say a bull buys on a stop 1 tick above this bar, betting on a failed bear breakout, a decent bull bar. Here, the market rallied 10 ticks above that entry price, so a bull looking for a 2-point profit was able to scalp out at 8 ticks. He buys 1 tick above the bar. It has to go 9 ticks above his entry price to make an 8-tick profit, and went 10 ticks. This is not a trap. The bulls successfully made 2 points on their scalp. On the other hand, let's say a bull looked at this and said, we have a wedge bottom, 1, 2, 3, or 1, 2, 3, a spike and channel bottom. We're probably going to get a swing up maybe to the top of the bear channel. So the bull buys 1 tick above the high of this buy signal bar, looking for a swing up 4 points. It has to go 18 ticks above the high of this bar for him to make his money. He buys 1 tick above right here. It has to go 16 ticks higher for his 4 points. And for his limit order to get filled, it has to go 1 tick above that. It has to go up 18 ticks above the high of the signal bar. If it goes up 17 ticks, it hits his limit order to make 4 points profit. Most of those traders would not get their profit. Their order would not be filled. And then when they see this, they have to be thinking, uh-oh, it hit my limit order, did not fill me, and now we have a bear bar. So maybe I'm trapped. Maybe this is a 17-tick trap. A lot of times, traders will look at a chart like this and say, well, it's a possible 4-point swing, but maybe it won't hit 4 points. I'll place my limit order 1 tick lower. So they'll try to get out with 3 3/4 points profit. In other words, they'll try to exit with 15 ticks. And that is part of the reason why you get the 17-tick trap. Traders looking at this saying, well, maybe it won't quite make 4 points. I'll place a limit order 1 tick lower. And that's part of the reason why the market will go to the 17 ticks and reverse down. You'll have some bulls exiting with 1 tick smaller profit. Bear scalpers, when they see the market hit a target for the bulls, they'll sell the reversal down, betting that the bulls will be exiting. Here, you have bears selling, betting on the lower high, 2 legs up, 1 pullback 2. They'll sell below that bar or below this bar. Here, you'll have bears selling, betting that the bear channel will continue, so they'll sell just below the low of this bar, 1 tick below the low of that bear bar. And look what happened here. Bears sold 1 tick below this bar, betting that they'll make at least a scalp. It fell 5 ticks and then did this, reversed up. So the bears who sold just below that bar, they get filled over here, are now trapped. And they'll buy back their shorts, and part of this reversal up is the trapped bears. It had to fall 6 ticks for them to make 1 point. It fell 5 ticks and hit their buy limit order where they wanted to take profits, did not fill most of them, and as it started to go up, they panicked and they bought. So we have a 5-tick trap and reversal. You have some bears who sold below this bar. They get filled here, 1 tick below that low, maybe hoping for a 2-point trade or a 3-point trade. Here, the market fell 13 ticks. Those bears who were hoping for 3 points needed it to fall 14 ticks to make 3 points profit. They sell 1 tick below the bar, and then it has to fall 12 ticks to hit their target. It has to go 1 more tick, total of 14 ticks to make 3 points. And instead, it fell exactly 13 ticks and reversed up, so it's a 13-tick trap. It's actually kind of a dumb thing to place a buy limit order at that price in this particular case because it has to fall below this low, and I think that's not a high probability bet. If I were taking this for a 3-point trade, I would try to get out 1 tick above 3 points. So I'd get out 1 tick above this low, just in case we got a perfect double bottom, which we did. As I said, sometimes traders who are not entirely confident that the move will fill their profit target will go for 1 tick less. Bulls hoping for 4 points, look at this, say it's not all that good. Maybe instead of trying for a limit order 16 ticks above my entry, I'll place it 15 ticks. Same with here. Bears selling here, thinking it has to fall below this to get 14 ticks for them to make 12. They'll place a limit order to get out 1 tick early. Here, I would not take that short, and I certainly would not place my limit order looking for a 3-tick profit. For me, the minimum scalp in the E-mini is 1 point, so I'm never going to be going to a trade planning to get out with 3 ticks instead of 4 ticks. Think about it from the perspective of traders looking for trades in the opposite direction. For example, here, bulls will think, okay, a lot of the bears know this is probably not going to fall very far, and a lot of the bears will probably be scalping for 1 point. It has to fall 6 ticks, so maybe I'll place a limit order to buy 4 ticks below, just in case it's a 5-tick trap, and I'll get filled. And the opposite is true here. A lot of bears will look at this and say, yeah, it's a strong rally, but it's probably not going to go above this high. Maybe it'll stay another lower high. And they know a lot of bulls will look to take profits at 4 points. So they know a lot of bulls have limit orders 17 ticks above this high. You'll have bears placing limit orders to go short, at least for a scalp, 17 ticks above this high. And they also know that this might be a 17-tick trap, so they'll place limit orders 16 ticks above this high. You have bulls and bears selling at 16 ticks above this high, and sometimes you'll get a reversal. A lot of times you'll just get a pullback far enough down for the bears to make a scalp. As I said, the bulls who bought above here for a 2-point scalp needed the market to go up 10 ticks to make their 8 ticks, and they got filled. They made their money. The bears know bulls will take profits there, especially since it's slightly lower than this high, and the bears will short exactly where the bulls are trying to get out. Opposite E-mini traders, the scalpers, are betting that the stop entry traders will not make their 1, 2, 3, or 4 points. So they enter in the opposite direction with limit orders, maybe a tick or 2 below the target for the bulls. Bears know the target for the bulls is 9 ticks above this. They know it has to go up 10 ticks, so bears will place limit orders to sell 1 or 2 ticks below that. The bears down here know the bulls might be trying for 3 points. The bears need it to fall 14 ticks to make 3 points. The bulls know that. And the bulls also see a potential double bottom, so the bulls will place limit orders to buy 12 or 13 ticks below that low, trying to trap the bears. The same here. The bulls know this is a bad-looking short. They know some bears will sell it, maybe only for a 1-point scalp. The bulls know it has to fall 6 ticks for those bears to make money, so the bulls will place limit orders to buy 4 or 5 ticks below that low, betting that the bears will be buying down there as well. If the bears are buying and the bulls are buying, the bulls probably will make money. The bears here, they might sell 4 ticks above this bar and scale in higher, betting that it's a bad buy and the bulls will be only scalping. In other words, the bulls do not have a lot of conviction and will not be holding for swing trades and will not be buying much higher. So they will not continue to buy. Bears will start selling either at this high, 1 point higher, 2 points higher, or maybe they'll start selling at 1 point higher or 2 points higher. And the same true here. The bears will assume it probably will have profit taking around 4 points above this high and that the market will convert into a trading range, so bears will sell. They might start selling 1 point above, 2 points, 3 points. I would not. The context is good for some kind of a swing up and the conversion into a trading range. If I'm going to be selling at bull profit targets, I probably would start selling at 3 points or 4 points up, 16 or 17 ticks above the high of the buy signal bar. Bulls buy with limit orders 4, 8, 12, 16 ticks below sell signal bars, betting that the bears will take profits there. And the bulls are buying for a scalp, betting on a trading range. Whenever there's a weak buy setup, bear scalpers will sell at the high of the buy signal bar. And they'll scale in 1 or 2 points higher, just below the profit targets for the stop order bulls. Strong bear breakout, trying to get a bull reversal. As I said, some bears will start selling here, sell more 1 point higher, sell more 2 points higher. It comes down to their original entry price. They exit break even on their first order, a profit on this, and 2 points profit on that. Here we have a bear inside bar at the bottom of a weak channel, and it's possibly a wedge channel after a bear breakout, so it's possibly a spike in channel bear trend. The bear sell signal bar has a fairly prominent tail. A lot of bulls will bet it's a bad bear flag. They'll place a limit order to buy at the low of that bar, and they'll buy more 4 ticks lower. They'll exit break even when the market gets back to their first entry, and then with a 1 point profit here. Some will hold in case we get a continued rally. Whenever you have trapped scalpers, other scalpers will do the opposite. You have bulls and bears buying at the same time down here. You have bulls and bears selling at the same time up here. That means profit targets create support and resistance. Profit targets for the bulls creates resistance because both bulls and bears will sell at those profit targets. Profit targets for the bears create support because both bulls and bears will be buying at that profit target. Forex scalpers often take profits at 10 pips, 20 pips, 30 pips, 50 pips. And if they enter on a stop, to make 10 pips, the market has to go 12 pips. To make 50 pips, it has to go 52 pips. If the market moves 1 pip less, then it traps traders. For example, let's say you have a bull scalper who looks at this and they see a pullback, maybe testing this high. Maybe this is a measuring gap. We'll get a measure move up. Maybe they'll place an order to buy 1 pip above the high of this buy signal bar, expecting the market to go up high enough for them to make a 10 pip scalp. If they buy 1 pip above this bar and they need 10 pips for a profit, that's 11 pips, it usually has to go 1 more pip before their profit-taking limit order gets filled. So that means traders buying on a stop above the high of this bar usually need a rally that goes up 12 pips for them to make a 10 pip profit. If the market only goes up 11 pips and then reverses down, they do not make their profit and they'll have to get out of their trade. So they could be trapped into a trade. And if the market reverses down at 11 pips, I call that an 11 pip trap. This is an example. Bulls might buy 1 pip above the high of this bar, have limit orders to sell 10 pips above their entry, which is 11 pips above the buy signal bar, and then if it starts to drift down, these bull scalpers will be trapped. They'll be still in the trade, but without their profit, and at some point they give up. The bear scalpers know that the bulls will try to get out with a 10 pip profit. Fairly small day, so a lot of bulls will scalp for 10 pips. So the bears will place limit orders to sell 10 pips above the high of a buy signal bar, betting that bulls will be selling there as well. Here, let's say we have bears expecting that you'll have trapped bulls and we'll get a reversal down. This is a final flag. Maybe we'll come down here or below. In any case, let's say bears sell 1 pip below the low of this bull bar. The minimum scalp in Forex markets is 10 pips. The market therefore has to fall 12 pips below this bar to make a profit, to make their minimum scalp. They sell 1 pip below the bar. It has to fall 10 more pips to hit their limit order. And for that limit order to be filled, it usually has to fall 1 more pip. So the market usually has to fall 12 pips for the bears to make 10 pips. If it starts to turn up before 12 pips, it's an 11 pip trap. That means the bears who sold are trapped. It hit 11 pips. Most of them did not get their 10 pips profit, and it reverses up. At some point, those bears give up. A lot of times, if traders are concerned as the market's falling, let's say a trader sells below this bar, and he's concerned that it's not falling as fast as he wants, he may change his order and try to get out 1 pip early. So instead of placing his order to make a 10 pip scalp, he'll try to get 9 pips. And that means that there'll be support 10 pips down. The market has to fall 11 pips for him to get filled with his order 10 pips below the sell signal bar for him to exit with a 9 pips profit. Also, you'll have opposite traders believing that the bears are scalping. So the opposite traders are the bulls, and they'll expect support around this low. They'll think most of the bears will scalp out for 10 pips. So the bulls will look to buy around where the bear scalpers will be taking profits. The bulls will place limit orders about 10 pips below the low of this bar. The market has to fall 11 pips for those bulls to get their order filled. So you have bulls trying to buy 10 pips below this bar. You have bears trying to buy 11 or 12 pips below that bar. And that can result in the market not quite filling the bears. If enough bulls are buying and if enough bears are raising their limit order by 1 pip, a lot of times the market will fall 11 pips instead of 12 and reverse up. And that results in an 11 pip trap. Here, some bears might look at this and say, well, I don't know, maybe it's a 50% pullback, maybe we'll get a double bottom, maybe I was wrong trying to get 10 pips, maybe I'll exit 1 pip early. Bulls know that, and they'll also be buying at the same price, maybe about 10 pips below the low of this bar. Has to fall 11 pips to get filled. So sometimes you'll have so many buy limit orders, both bulls and bears buying 11 pips below the low of the signal bar, that the market does not fall 12, and you get the reversal up, and you get an 11 pip trap. Bears trying to get out with 10 pips profit are now trapped. They do not get filled, and they have to exit, and they gave up in here. Different data from different brokers. Also, there are mini pips, so instead of 11 pips, it could be 11.3 pips, 11.9 pips. Also, because some charts only show the ask, the offer, and not the actual trades, you might not get filled, even though it looks like you're getting filled. So Forex traders trying to scalp for 10 pips, difficult thing to do. Most Forex traders should not be doing that. But experienced Forex traders can do that. But they can only do it if they can think fast. They have to make quick decisions. I want to talk a little bit about fading weak setups. Fading means doing the opposite. So if there's a weak buy setup, traders will sell. Let's look at this. We're selling off, and we're trying to reverse up. Some bears will look at that and say, oh, that's not a very good buy signal bar, especially after such a big bear bar. I bet the buy signal is going to fail. So the bulls buying at this high on a stop, or 1 tick above this high on a stop, are probably trapped, or they will get trapped. So the bears will sell with a limit order exactly at that high. They'll sell at or slightly above. A lot of times I'll just place a limit order at that high and get filled right there, betting that it's a bad buy. Protective stop, either above the top of the sell climax or the top of the bear trend. My stop is up here. A lot of times when I take that short, I'll place a limit order to sell more 1 or 2 points higher, betting that it might go a little bit higher, maybe a 50% pullback, but odds are my stop will not get hit before I'm able to make a profit. So the bears sell this high, and they sell more 4 ticks higher. It has to bounce 5 ticks to get filled. The bulls know their buy setup is weak. A lot of the bulls are simply trying to scalp for 4 ticks. It has to go up 6 ticks to get filled. We have a buy signal bar with a bear body after a very big bear bar. It's not a strong buy setup. Plus, it's following a big bear bar. If the market goes up 5 ticks, it therefore hits the limit order for the bulls. So the bulls buy 1 tick above this bar. They get filled on that gray line right there. They place a limit order to take profits 4 ticks higher, which is this gray line. And you can see the market exactly hit their limit order. If it does not get filled pretty quickly, those bulls will get out, afraid that they'll be trapped, a 5-tick trap. So bulls and bears are both selling there. The bears are selling, betting that it's a weak buy signal, and the bulls are selling there as well. We have a lot of limit orders 4 and 5 ticks above the high of a bad buy signal bar. And that can result in the price falling pretty quickly. Many of these bears, they'll sell the high of this bar and 1 point higher. They'll take profits at their first entry price. So they get out break even on their first sell and with a 1 point profit on their second. And the bulls who bought on a stop 1 tick above this bar, when it's reversing down, they're trapped. They're trying to get out break even. So you have bulls and bears selling. Some of the bears will swing part of this. A lot will just simply scalp, depending on the context. If this is part of a huge bear trend, a lot of the bears will not take profits here. They'll hold for a swing down. The opposite is true if bulls think the bears have a bad sell setup. Bulls will buy the low of a bad sell signal bar. We have a bear trend. Maybe this is a bear flag. It lacks consecutive big bear bars, and we have a pretty good reversal bar here and a second bull bar here. Bears selling here are taking a chance that they'll get stopped out with a losing trade. A bad sell signal bar, and therefore a lot of bulls will buy at that low, betting that the bear breakout will fail, and they'll look for a scalp. They might buy more 10 pips lower, but it requires an 11 pip sell-off for them to be able to scale in 10 pips lower. These are scale-in bull scalpers. Here we got a 14 pip sell-off. Bulls who bought this low, betting on the bad bear flag, they buy more 10 pips lower. It fell 14 pips, so they would have been filled. Again, bulls only do this if they're confident that this is a bad bear flag and that it's going to lead to a trading range or even a rally instead of a continued bear trend. Bulls doing that, they might have to risk about 30 pips from their first entry. So they buy here, buy more 10 pips lower. Maybe they're willing to buy more 20 pips lower. In general, if you're doing that kind of trading, you have to risk about 3 times the size of a minimum scalp, 10 pips. So you have to risk about 30 pips. Most traders should not be doing this. They certainly should not be doing the scaling in. Experienced traders do it regularly. The bears know that selling below this bar is a bad short, probably not going to be profitable. We have a bull body and consecutive bull bars and a weak sell-off. Arguably a wedge, 3 lows, 1, 2, 3. Might get a couple legs sideways to up. And these bears will be quick to buy back their shorts. Most of them, if they are scalping, are just looking for 10 pips. That means that there'll be a lot of buy limit orders about 12 pips or 11 pips below this low. So if the market falls 12 pips, probably buyers. Weak bear flag, so probably buyers at the prior low. Bears will be buying at the prior low to take profits. Bulls will be buying at this low, betting that we'll bounce up enough for a scalp. And bulls know that, so they'll buy here, they'll buy more 10 pips lower, betting on a trading range. They can exit their entire position at their original entry price, getting out break even on this first buy, and with a 10 pip profit on the second buy. Some bulls will not buy this low. They'll simply take the second entry 10 pips lower. Other bulls will say a new low probably will fail, and they'll simply place a limit order to buy at that low. And they'll try to get out at the place where, theoretically, bulls would begin to start to buy at this low. So profit-taking area. If traders think the context is good enough for a swing up, they might swing part. But in general, small bars, prominent tails, small range, traders are scalping. In this video, I talked about 5 tick traps and 11 pip traps, where the market goes almost far enough for a scalp and then reverses. And finally, I talked about fading weak setups. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on channels. A channel is simply 2 lines that contain the price action. And to draw a line, you need 2 points. I'll finally talk about the 70% rule, which means that if there's a breakout of a channel, up or down, does not matter if it's a bull or bear channel, there's about a 70% chance that the breakout will fail and reverse and go to the opposite side of the channel within about 5 bars. Every market on every time frame is always contained within channels, whether or not you see them. For example, here we have a very tight bull channel, and here we have a broader bear channel. And within each channel, there are also smaller channels. Here we have a broad bear channel. We have lower highs and lower lows. And within it, we have a bull channel. And within that bull channel, there are smaller bear channels. Let's look at this bull channel for a second. There's a line below and a line above. In a bull trend, the line below is the trend line. In a bear trend, the line above is the trend line. In a bull channel, a bull trend, the line above is the trend channel line. Bull channel, we have 2 points, so we can draw a line. This is the bull trend line. 2 points, we can draw a line at the top of the bull channel, and that is the channel line. Now, we have a broad bear channel, and I can draw a line across these 2 points, and that would be the trend line. And I could draw a line along the bottom, connecting maybe this low and that low, or this low. We have 3 points down here, and the line along the bottom is the trend channel line. So the trend line is on top. It's a bear trend, so the line is on top, the trend line. And the channel line is on the opposite side of the channel, and in a bear trend, it's on the bottom. Here is a 5-minute chart, and we have a bull channel. I have a reversal up, so that's a point that I can use to draw a line. And then maybe we're trying to reverse up here, so that would be a second point. We have a reversal sideways to down. I can use that to draw a line. We have a little reversal down here. I can use that to draw a line. We have another reversal here, another reversal here. This one, if I were to draw a bull trend line here, this would be a break below that bull trend line. So this is possibly the start of a swing sideways to down. And therefore, this is probably a more important point than these points. I'll draw the line connecting this high to that final point, even though when I do that, these bars are above the line. Who knows what is going on other time frames? This is the chart that I'm trading. And on some other time frame, a higher time frame, a 60-minute chart, a daily chart, a weekly chart, there's probably an opposite trend. So a bull trend on the 5-minute chart could be a bear flag on a 60-minute chart or a daily chart. Well, look at this. Here's the daily chart, and this little red box is today. You can see it's a bull trend, opening in the middle, closing on the high, and that is today. This is not the entire day. This is part of the day. The point I'm making is it's a reasonably strong bull trend, but it's really simply a little pullback in a very strong bear trend on the daily chart. Just knowing that it's a bull trend here does not tell you anything about other time frames, and other time frames can be in opposite trends. For example, if I were looking at a 1-minute chart, this would be a bear trend. Now, on every time frame, on every chart, every market, channels dominate the market. Every market is always on every chart, either in a trend or in a trading range. Here we have a breakout, and breakouts are brief. On any chart, a strong breakout typically will be 5 to 10% of the bars on the chart. The other 90% of the bars will either be in a channel or a trading range. Market cycle, you get a breakout, a channel, and a trading range. Here we have a strong breakout, and then many more bars are in a channel. I can draw a line. I have 2 points, 2 reversals, up and then up. And then look what the market did here. It went sideways. But I have 2 reversals down. I can draw a line across the top. I have 2 reversals up. I can draw a line across the bottom. And remember, my definition of a channel is any collection of bars that can be contained between 2 lines. A trading range is a channel. It's a sideways channel, a horizontal channel, but it's a channel. I always draw my lines in a way that best highlights what the market is trying to do. Sometimes that results in bars being above or below the lines, extending beyond the channel. Other times it results in reversals that do not quite reach the lines. Here we have a reversal up, another reversal up, another reversal up. Initially I'll draw a trend line in a bull trend connecting these 2 lows, but then I see a reversal up here, and I'll change the line and I'll use this low and that low. When I do that, this bar is below the line, and therefore this is an overshoot. When I draw a line below here, maybe connecting that low and this low, and then create a parallel, and I want to contain what is actually taking place, to me it looks like this high and this high best illustrate what the market is doing. And if I use those 2 highs, then this high in between is above the line, and it's an overshoot of the channel. A lot of times you don't appreciate overshoots and undershoots until after a pattern is complete. So for example, you would not see this as an overshoot of the bottom of the channel until after the market reversed up here. That's okay. And the same is true here. Initially, you draw a line using this high and that high, and then you might decide that this is a better high to use because it creates a parallel channel. And once you do that, then this high becomes an overshoot. It went above the top of the channel. Here, once you have this channel drawn this way, you see the market came down near the line and reversed up. It's an undershoot. Had I drawn the line using this low and that low, then this clearly would be an undershoot. It's still a test of the bottom of the channel, but it did not reach the bottom of the channel, just like sometimes the test will go beyond the bottom of the channel. Traders are always looking at channels, and one of the reasons is they're looking for transitions. We have a bull trend, very strong breakout, and then a channel. But everyone knows that a channel eventually evolves into a trading range 75% of the time. And if it starts to evolve into a trading range, traders need to know that because they'll trade differently once the market is in a different part of the market cycle. When the market's in a channel, especially a tight channel, traders will only look to buy. But once it breaks below the channel, it might be becoming a trading range, in which case traders will also be willing to sell. Bull breakout evolved into a channel, channel evolved into a trading range. And once it's in a trading range, it's still a trading range in a bull trend, so it's a bull flag on some higher time frame. Traders definitely have to favor buys. However, because it's a trading range, they'll also be willing to sell. Here we have a bull trend. We're in a channel. A channel is a type of bull trend. And everyone knows that 75% of the time, a channel will evolve into a trading range. A bull channel is a bear flag, 75% chance you'll get a break to the downside, and then a trading range or a bear trend. 75%. That means 25% of the time, you get a bull breakout, and the market cycle starts over. Breakout, channel, and trading range. And that's what we had here. We had a strong bull breakout above a bull channel, so the market cycle starts over. Breakout, and then channel, and then probably a trading range later on. So we had a bull trend that became an even stronger bull trend. We have a bull breakout above a bull channel and the creation of an even stronger bull trend. Breakout, channel, eventually probably a bear breakout below the bull channel, and then the formation of a trading range. I can draw a line using a reversal up here, a reversal up there. Here's the bottom of the channel. I can draw a line using this high and that high, or this high and that high, or simply a parallel of this line. In any case, we have a big bull bar closing on its high and above the top of the channel. Now, remember, 75% of the time, a bull breakout of a bull channel will reverse and test the bottom of the channel, which is what it did here. Will this breakout lead to a stronger bull trend, or is it a buy climax and a failed breakout that will lead to a reversal down to the bottom of the channel, and then either a bear trend or a trading range? In this case, we had a bull breakout above a bull channel, and then a bull channel. Traders think of it as a bear flag because 75% of the time you get a break below the bottom of the channel, below the bull trend line, and either a conversion into a trading range or a reversal into a bear trend. In this particular case, we got a reversal into a bear trend. We have a give up bar here, a big bear trend bar closing on its low, and it became the spike of a spike and channel bear trend. So spike and then pull back and then channel going down. Here we have a bull trend and a bear trend. And a channel that rises is a bull channel. And this is a breakout initially, and then it became a very tight bear channel. Bull channel, trend line below, trend channel line above. In this particular case, I used a parallel. I created this line using this low and that low, and then I made a parallel and dragged it over here to some high that best contains most of the price action. A channel going up, bull channel, a channel going down, bear channel. Even though it's very tight, it's still a channel. On a higher time frame chart, it's probably a breakout, but on this particular chart, it's a channel. Traders are always paying attention to reversals because reversals allow them to draw lines. And as soon as the trader sees a second reversal, he can start to draw lines, this low and that low. high or low, so it's a bull channel at this point. Initially, when you only have one point above, I start with a trend channel line. So I take this line, I create a parallel, and I drag it up to that high to get some idea of what the bull trend might look like. And then I'll pay attention to what the market does if it gets up near that line. If it turns down from lower, then I'll start drawing a trend line above this high and whatever low we have here. We know there's a channel here, even though we don't have a good point for the second line. The channel right now looks like it's up. We have a higher low, but in fact, it could be down. It could be this high and that low, and we could start channeling down. But this is what I'm thinking is a reasonable thing to consider. We have a strong bull breakout and then a reversal up after a weak sell-off, maybe a spike and channel to a higher low. So the odds are we're going to test up. And as I see more bars, I redraw lines, more bars, more information. And then look what happened here. A strong breakout, but terrible follow-through once it got to the area of that line. That tells me that the market is aware of this line. A lot of computers are using this line. They created this trend line below. They created a parallel. They dragged it to this high. And this hesitation at that line tells me that a lot of computers think this line is important. Maybe it's a resistance. Maybe we reverse down. Maybe we break above it. We are reversing down here. So I'm going to draw another line using this high and this high. And I'll wait to see what happens. If we go higher, I'll draw another line. And if we keep getting higher lows here, this line then becomes unimportant, and I'll draw another line with this as 0.1 and maybe this as 0.2. Each new bar that gets added to the chart gives me additional information, and then with each piece of additional information, I reevaluate what I'm doing, and that means that a lot of times I'm erasing old lines and creating new lines. All of us learned when we took mathematics that lines need 2 points. You need 2 points to draw a line. Here we have a lot of points. Every reversal is a possible point. Reversal up, and then a lot of reversal up, and then reversals down, and every one is a possible point that I can use to draw a line. I trade based upon what happens at those lines. Is the market paying attention to the line? When the market gets there, does it break through it or does it reverse? Reversal down, I draw a line. Here the market tested the line, it broke through it. Here I have a very tight channel, and again the market broke through it. Again, a tight bull channel this time, and the market broke sideways and then down. A tight channel, a fairly tight channel here, and the market tested it and broke to the downside. So these are all breakouts. Other times, the market hits the line, it reverses. It breaks through the line, it reverses. It breaks through the bottom of the line, it reverses. Breaks above the top of the line, it reverses. It breaks below the bottom of the line, it reverses. So you can either get a breakout beyond the line or a reversal. In both cases, there's a possible trade. Traders are mostly looking for reversals when they draw lines. We reverse down here and we reverse down here. So I could draw a line using these two highs, but then we broke above it, broke above the line, and we reversed down again. So I could draw a new line using this as 0.1 and this is 0.2. Since the line is sloping down, it's a bear trend line. Therefore, it's a reasonable possibility for a top of a bear channel. Bulls see the bear channel and they hope that the bear channel is a bull flag, looking for 2 legs down, 1 pullback 2, and bulls are hoping this bear breakout fails and is followed by trend resumption up. So bull trend, pullback, and then resumption of the trend. Bears are hoping bull trend, double top, and the start of a bear trend. A bear channel, I always think of it as a bull flag. The odds are it's going to get a bull breakout at some point. And we have a reversal up and another reversal up. Possibly a high 2 buy setup, high 1, and then second leg down, possibly high 2. Right now, this little bull doji does not look like it's enough to reverse these 2 big bear bars, but it might be. It's around a 50% pullback of this bull trend, and a lot of times the bulls come back at around 50%. We have a bear breakout below a trading range, yet the follow-through bar has a bull body. That's bad follow-through, and it increases the chances that if we go down any further, this more likely is a bear leg in a trading range and less likely the start of a bear trend. If the bear breakout was followed by a second or third consecutive bear bar, it would increase the chances that this sell-off is the start of a bear trend. But this bad follow-through makes it more likely that this bear trend is really simply going to be a leg in a trading range or a bull flag. Remember, we're still above the bottom of the initial very strong rally, and we're about 50% down, maybe a little bit more. So the odds still favor the bulls. It's more likely that this will be a bull flag. Remember, every bear channel is a bull flag. At least in my mind, I think of every bear channel as probably having a bull breakout. So every bear channel, I think, is a bull flag. And every bull channel, I think of as a bear flag, because 75% of the time, there will be a break below the bull trend line. Now, if there is a channel here, a bear channel, bulls are looking to buy a reversal up. You need 2 points to draw a line. We have 1 and maybe 2. So far, we only have 1 for sure, but if we start to go up here, then this becomes 2. Before it turns up, we still have a second line. We have an obvious trend line above. Traders can create a parallel and then drag it down here to the low point in between, and that would create a channel. This might already be breaking below the bottom of the channel and reversing up. So we have this bear trend line, create a parallel, drag it to the low point in between, and you have a channel. And this could be an overshoot of the bear channel that is reversing up at around a 50% pullback in a bull trend. The odds still favor the bulls at this point. The bears have not done enough to make traders think that the bears have taken control. Traders want to see what will happen here. Will the bear trend continue down and become a bear trend, or is this the end of the selling and the resumption of the bull trend? The line is important. Traders want to see what happens, and so far it looks like the market is stalling at the line. Possibly a big high 2 bull flag, 2 legs down, 1 pullback 2. So if we get a reversal up here, that would be a high 2 bull flag. This would simply be an overshoot, a failed breakout below the bottom of the channel. Bulls look to buy a reversal up at the bottom of the channel. Therefore, they will place a buy stop to buy just above the high of this bar, because that would be a reversal up from the bottom of the channel. And they hope that will get some kind of a second leg up. Maybe leg 1, pullback, leg 2. Maybe simply a test of the top of this sell climax. Maybe a test of this high, maybe a test of that high. In any case, there's enough room up there for at least a scalp, and bulls will buy above the high of this bar. This bar did not go above the high of that bar. We went lower. But now look what happened. We have a second buy signal, a second attempt to reverse up. The second failed breakout below the channel. We broke below the channel, tried to reverse up, broke below the channel again, trying to reverse up again. This is a micro double bottom. Down and up, down and now up again. So bulls will buy above the high of this bar. This is a higher probability buy than simply buying above this bar. This micro double bottom means that the bears twice failed to break below the channel, and that increases the probability that the reversal up will be profitable. Bulls will therefore place a buy stop just above the high of this bar, and they'll get long here. It's a good-looking buy signal bar, a micro double bottom in the bottom of a channel, and a pullback in a bull trend. The math is good. The probability is good that bulls will make money buying right there. And they did. No reason to get out here. No reason to get out here. It looks like we're in the process of a swing up. Maybe leg 1, pullback, leg 2. Maybe we'll go up here somewhere. Lines have to make sense. They have to look good. And if they don't, computers will ignore them. Initially, you draw a line with this low, that low. Once the market goes below the line and starts to reverse up, you use this low and that low. Will computers be using this high and that high? They will, maybe initially, until they start to see that using these 2 bars for a trend line below make this expanding, and this is probably too high for the market ever to reach there. If the lines are too divergent, most computers will ignore that higher line, thinking that the market will never get there. Here we have a strong bull breakout, a pullback, probably a spike and channel up. And we did have that here. We got 2 legs sideways rather than down, and then we have another breakout. A line like this that is not close to parallel to an obvious line probably not going to be useful. The market's probably not going to reach it. It's better just to ignore it. In general, lines that are closer to parallel or very parallel are much more reliable. Obvious reversal up here, obvious line, create a parallel, drag it to the high point in between, and then see what the market does when it gets up to that line. And you can see a lot of computers did exactly that. They used this parallel line and created a parallel channel, and a lot of traders see it as resistance. Bulls are taking profits, and bears might be starting to sell up there. The closer the lines are to parallel, the more computers will use them, and the more likely they will create support and resistance. Resistance at the top of the channel, the market repeatedly is trying to break above it and failing. Again, you need 2 points to draw a line. And here we have possible 2 points, 1 and then 2 or 2. And then maybe this is 2. So maybe it's 1 and 2. And then maybe this is bar 3, the third point. Now, if there are a lot of bars between 1 and 2, and very few bars to bar 3, traders will not view this as 3 points, 1, 2, 3, or 1, 2, 3, 4. They'll view this whole thing as point 2. So 1 and 2. There has to be pretty good symmetry. The distance between point 1 and 2 has to be similar to the distance between point 2 and 3, and if not, traders will ignore the line, or they'll count it differently from how you're counting it. Here we have just a few bars, and we have maybe 5 times more bars between 1 and 2. So computers will not be looking at this as point 1, point 2, point 3. They'll simply look at it as point 1, point 2, and maybe that as point 3. 32 bars between point 1 and 2, only 3 bars between 2 and 3. This is not a 1, 2, 3. This is a 1 and a 2. And they'll look at this collection of bars as simply point 2 and choose any one of them as the point 2 bar. So point 1, point 2 or point 2, and then point 3. There's still not all that good symmetry, too many bars between 1 and 2 or 2 compared to between 2 and 3, but at least it's not as bad as this as 2 and 3. So more computers will pay attention to this, and they'll want to see what the market does at that third point. We have a reversal down and a reversal down. So I can draw a line, 1 and 2, and that line is probably acceptable through here. But once you start doing this and this is too small of a pattern to influence the market after a bear breakout like this. So you can say point 1, point 2, point 3. No, computers are totally ignoring that after this takes place. Very little distance between point 1 and 2, and point 3, at this point, this is point 3, and the market's nowhere near it. Do I keep looking out here for point 3? No, there'll be too many bars between 2 and 3 compared to the number of bars between 1 and 2. So that is not an important line. Computers are not going to be looking at what takes place out here at that line. No one's going to use that line to place trades. There'll be many other more important lines. For example, connecting this high and this high, or this high. This becomes a much more important channel. Only 7 bars between 1 and 2. And at this point, there are 40 bars between 2 and 3, and there's not even a point 3 yet. Bad symmetry, too many bars between 2 and 3 compared to between 1 and 2, and there's not even a point 3 at this point. So you may have to go out 100 bars, 200 bars before the market gets to that line. And at that point, computers will not be looking at that line. There'll be many other lines that are more important. 2 points to draw a line, 1, 2, 3? I don't think so. Once you get strong breakouts like this, these reversals become minor, and computers pay attention to major highs, a high that's followed by a strong bear breakout. This is a major high, so this is the point that the computers will use. A reversal down, very strong bear breakout to a new low, a major high, fairly major high. Computers will use that point and this point, and they'll say, okay, we broke to the upside, but the bear trend resumed within 5 bars, which happens 75% of the time. They draw this line to see what happens in the general area of the line, and then they look to sell a reversal down, expecting a resumption of the bear trend. That line gives traders a location where they can start to look to sell. strong bear reversal here. At some point, traders redraw the line, maybe somewhere in here. They start wondering if this is the start of a new leg down. So they'll start to ignore this line and then start to use this line, and they'll watch to see what the market does when it gets near it. Traders like to use major highs and major lows for lines. This is a fairly major high. It's a higher low here, but it's still a strong bull breakout and a pullback lasting a lot of bars. The same with here. And you can see lots of major highs and lots of major lows. Reversal up in a bull trend. Point 1, point 2, strong reversal up. Found support here, but broke below the line here. Traders will ignore that line and then draw a new line. Initially, traders might draw a parallel of the first line and then see how the market responds. So they get a bull trend line, create a parallel, and see what the market does. They have a bear trend line, create a parallel, see what the market does. A bull trend line, create a parallel, and see what the market does. A bull channel line, create a parallel, and see what the market does. A bull channel line, create a parallel, and see what the market does. As soon as you have 2 points, you can draw a line, and you immediately know that the market's in a channel, whether or not you're aware of what the top of the channel is. You know that you can draw a line, here a bull trend line, and therefore it's a bull channel. There's some line on top that traders will see as resistance. And when the market comes down to the line, traders will look to buy a reversal up here, or a second entry here. They'll also look to take profits on a reversal down at the top of the channel. If the channel is broad enough, some traders will even short on the reversal down from the top of the channel. Or at a prior high. For example, at this high, bears sold and made money. Even at this high, they sold, maybe sold more up here. This pullback fell below that breakout point, so the market's in a stairs pattern, and bears will sell new highs and scale in higher, betting that they'll make money. They make a profit on their second entry, and they get out break even on their first. You have a reversal down, you can draw a line. The initial line was probably here, maybe traders looking for a wedge, 1, 2, 3, but it broke strongly above it, reversed down again, so now we have the ability to draw another line. And traders like to see what happens at the top of the channel. Will it reverse down? And they also like to see what happens at prior highs. Will it reverse down? Will limit order bears make money? Will bears selling at this high, scaling in higher, make money? Well, those are limit order bears. Limit order bears here made money. They sold with a limit order at this high, and it went down far enough for a scalp. That increases the chances that the bull channel will soon evolve into a trading range. I talked several times about the 70% rule. I'm going to talk a little bit more about it here. As I said, you can call it a 70% rule, maybe 75% rule, but the general idea is that if you have a bull trend and you get a breakout above the top of the trend, 70% chance that you'll get a reversal down within 5 bars. If you get a breakout below the bottom of the channel, 70% chance you'll get a reversal up within about 5 bars. And you have a 30% chance that the bull breakout will be successful and start a new market cycle, breakout and channel, and then trading range. Because there's a 70% chance that the market will reverse down to the bottom of the channel, traders will look to sell below bars at the top of the channel, looking for at least a scalp down to the bottom of the channel, assuming there's room here for a scalp. If there's not enough room for a minimum scalp, traders should not take that short. Instead, they should only look to buy reversals up at the bottom of the channel. A bull trend, easier to make money looking to buy at the bottom of the channel than to sell at the top of the channel. A good way to buy, place a stop just above the high of a bull bar at the bottom of the channel, looking for a resumption of the trend up, a continuation of the channel. I think this is pretty interesting. Look at this chart. It's the same as this chart, but the time frame is different. This is a 1-minute chart, and this is a bull breakout above the top of a bull channel. Now, what about my 70% rule? 70% chance the breakout fails within about 5 bars and goes down to the bottom of the channel. Well, there's an additional point about that 70% rule. The 70% rule works on the highest time frame where you can draw the channel. And is this 1-minute chart the highest time frame where I can see this channel? No. In fact, this channel rallied for 200 bars before it reversed down. And my rule is 70% chance it reverses down within 5 bars, but on the highest time frame chart that shows the channel. Here's a 30-minute chart of this 1-minute chart. And here's the same bull breakout that we have right here. This went up for 200 bars, and this went up for 5 or 6 bars. And 70% chance you reverse down within 5 bars, well, here's 6 bars, and it started to reverse down here. And reversal down, in general, if you get a reversal, traders expect 10 bars, 2 legs. Here we have 1 leg. It's about 10 bars, but it's only 1 leg, so probably traders will sell the first rally, and there'll be a second leg sideways to down. I can draw the channel this way, and there's still many bars here, maybe 100 or more bars above the top of the channel before the reversal took place. But if I draw it this way, using these 2 points, create a parallel, anchor it here, the market's reversing down within 2 bars, minimum goal, a test of the bottom of the channel. Some computers will use the green line, other computers will change their minds and then use this orange line for the channel. And they'll look to sell a reversal down if the reversal comes within about 5 bars. This is consistent with my 70% rule. I look at the highest time frame chart where I can draw the channel and I expect the reversal down to come within 5 bars of the bull breakout above the channel on that time frame. This is not the highest time frame that shows the channel. Obviously, this is a 1-minute chart. I can draw the same channels on a 30-minute chart. This is the highest time frame, so I'm looking for a reversal within 5 bars here, not within 5 bars here. I talked earlier how traders like to see parallel lines, but lots of channels do not have parallel lines. Here we have a small double top, maybe triple top, and a small double bottom, parallel lines. It's a channel. It's a trading range, but it's a channel, and we got a bull breakout. The lines can also converge instead of being parallel. They can get closer together. For example, we have a lower high, and we have a higher low. This is a channel with convergent lines. It's a triangle. As soon as you have 3 pushes up or 3 pushes down, and the lines are convergent, you have a triangle. So 1 high, 2 high, 3 highs. That's all I need to conclude that it's a triangle. And here we have a bull breakout. A triangle is a type of channel where the lines get closer together. They converge. Lines can also diverge. So we have a higher high, a lower low, and we tried to get another lower low. We reversed up several times. This is also a channel. It's a horizontal channel where the lines are divergent. It's a type of expanding triangle. Anytime you can draw 2 lines on the chart and they contain the price action, you have a channel. Whether the lines are parallel, get closer together, convergent, get further apart, divergent. Traders will still watch to see how the market reacts near the lines. In this video, I talked about channels having 2 lines, and I said that to draw 1 line, you need 2 points. And then I moved on and talked about the 70% rule, that if you get a breakout above or below a channel, 70% of the time, the breakout will reverse and go to the opposite side of the channel within about 5 bars. However, that rule only applies to the highest time frame that shows the channel. So if a channel is present on the 1-minute chart and the breakout goes 20, 30, or 100 bars beyond the line before reversing, look at a different chart, a 5-minute chart, a 15-minute chart, 60-minute chart, to see if the same channel is there. If so, look at the highest time frame chart that has that channel, and then look for a reversal within about 5 bars. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on channels. I'm going to begin by using the Forex market to show examples on how to draw bear channel lines, and then I'll move on to the E-mini market and I'll talk about examples on how to draw bull channel lines. With any chart, I'm always looking for reversals. Here we reversed up again. So we have 2 points and I can draw a line. Here we went up and then down, so we reversed down again. I can draw a line across the top. The market might be in a broad bear channel, it might be in a bull trend. As soon as there are 2 reversals, I like to draw lines. So for example, let's take a look at the bear possibility here. We reverse down, so I'll start by drawing a line connecting this high and that high for a possible bear trend. I could also draw the bull trend line, and I might later on, you'll see. Right now I'm using this to draw a possible bear channel. Again, two reversals, I can draw a line, and I begin to look for a possible bear trend. In this case, big swings up and down, possible broad bear channel. As soon as I have one line, I like to create a parallel and then drag it to the lowest point in between to get an idea of what a channel might look like. In general, I'm looking initially for channels that are fairly parallel. So creating a parallel of this line and then dragging it down to the lowest point in between gives me an idea of where possible support might be. If this is a bear trend, we go up and down, it will tend to find support at the bottom of the channel. And if it's a bear trend, most bear trends, at least at some point, are contained in a fairly parallel channel. Reversal down, 2 points. I draw a line, I create a parallel, drag it to the lowest point in between. And now we have a possible broad bear channel. What will the market do if it gets down to this blue line? Will it break strongly through it? Will it bounce up and test the upper line? We got near it and we reversed up. In fact, we did not even fall below this low. We have a higher low, so now we have a double top. Most double tops are not perfect. The second high is usually below or above the first high. We also have a double bottom, a slightly higher low double bottom, but still a double bottom. Are we in a bear trend? Well, yes, we're getting lower highs. Are we in a bull trend? Sure, we're getting higher lows. That also means that we're in a trading range. We reversed up again. Whenever I see two reversals, I'm going to draw a line. Every bar that gets added to the chart gives me new information, and with every piece of additional information, I update what I think will happen with the bars to the right that I do not yet see. I have two reversals up. I can draw a line. Now, are we reversing down here? We might be. So at this point, I'm thinking about a possible line connecting this reversal down and that reversal down. We have three reversals down, 1, 2, 3. Whenever the market's in a trading range like this, and there are three reversals either down or up, it's also in a triangle, breakout mode. At this point, it's in a bear trend. We have lower highs. It's also in a bull trend. We have higher lows. And whenever it's both in a bull trend and a bear trend, it's in a trading range. If the market trades down here and you look to the left and say, well, where did that bear trend begin? You would say that it began right here. So we are in the early stages of a bear trend. On the other hand, if the market ends up here, you'll say, oh, well, the bull trend began over here. So this is also in a bull trend. Very common for the market to be both in a bull trend and in a bear trend at the same time. And sometimes the probability of each is about the same as it is here in a triangle. I said every time I get a reversal, I think about drawing a new line. I have a reversal up here. I can draw a line using this low and that low, or this low and that low. And I pay attention to both. At this point, you don't know which line will be more important. And now we have four lines below. We have this one, we have these two new ones, and then that one. All of them might be important. Right now, clearly, these two are important, but I leave all on until it's clear that one or more is no longer important, until it's clear the market is ignoring the line. The bear trend line, right now we have two, here, and either one could be the more important one. The market could go above this high and reverse down at that line, and that tells me that the market is paying attention to that line, and I would then erase this line. You can look at this and say, wow, Al, that's way too much work. Trading is a lot of work, and if you want to make money, you have to do the work. We have a double bottom and a bear breakout. We have three pushes down, 1, 2, and 3. Whenever the market has three pushes down and reverses up, it's a type of wedge bottom. It does not matter that the second low is above the first low or above the third low. That's irrelevant. The market tried hard 3 times to get a downside breakout, and now it's reversing up. It does not matter even if it's not a wedge shape. It's still the same forces that create a wedge bottom. So I think of a failed breakout below a double bottom as a type of a wedge bottom. You trade them exactly the same. Should I buy above bar 3 right here? Well, we have 3 bear bars and 2 are fairly strong, decent size, closing on their lows. In general, you want to wait for a second entry buy. This is a micro double bottom also. We went down and up, and then down and then up. But theoretically, you could buy above here. It is a reasonable buy. You're at the bottom of a trading range and you have a second entry buy signal when you get above this bar. We continued down for a second leg, reasonably strong bear leg, and this became a bear flag. We went up, we went down, we went up, we went down again. And this bear breakout fell far below that pink line. The market's ignoring that pink line. It tried to pay attention to it here, but it's clear that it's ignoring it. Now, if anything, it's resistance. We turn down from it. Whenever the market looks like it's ignoring a line, I'm going to ignore it as well. I don't want too many lines on the chart because then it becomes too confusing, too difficult to follow what the market is trying to do. A reversal down, a surprise reversal down, small double top, 1, 2, double top bear flag, or low 2 bear flag on a smaller time frame, a pullback from the breakout below these 2 lows. Big bear bar, probably a second leg down. This could be the extent of the second leg down. In any case, we rallied and we reversed down. I can draw another line. Two ways to draw a wedge bottom, 1, 2, 3, or 1, 2, or 2, and 3. Let's say 1, 2, and 3. There are 2 ways to draw a wedge bottom here. Whenever there are 2 ways to draw the same pattern, some computers will use one, other computers will use the other. We have a bear breakout. Anytime you have a big trend bar, it's a breakout. So we have a big bear breakout. But look at the follow through. We have another bear breakout. And look at this, a bull bar. Another bear breakout, a tail on the bottom, followed by a doji bar and a reversal up. This is weak follow through. Whenever you have a bear trend that has decent bear bars, but bad follow through, that bear trend probably is going to be a bear leg in what will become a trading range. Trading ranges have legs that go down, they have legs that go up. And because of this bad follow through, traders are expecting that there will be a bull breakout above the bear channel, the wedge bottom. Bulls will begin to buy reversals up. Some bulls who bought above this high or that high are still long. They might be using a wide stop, maybe based upon a measured move down from this double bottom, a breakout below the double bottom, and they'll use a wide stop, and they'll scale in lower, above a bull bar, or maybe even above this small doji reversal bar. So some of these bulls are using wide stops, holding long, and looking to scale in lower, betting that the bad follow through after the bear bars means this is a bear leg in what will become a trading range, or possibly even a bull trend. So they'll buy more above each new reversal attempt up. Let's say this is the first entry that a trader takes. Let's say he did not take this or this and he buys here. Arguing it's a wedge bottom, 2 different ways to draw it, 1, 2, 3, or 1, 2, and 3. And it's also at the bottom of a parallel created by this original line. A line right here. We're reversing up from it. Markets tend to reverse if you can draw parallel lines like that. This trader at this point is feeling good. Not great follow through. So just like the bears had bad follow through on the way down, the bulls are getting bad follow through on the way up. It looks like a bull leg in a trading range, but it's still a reasonable buy. And if you have a wedge bottom, traders look for 2 legs sideways to up as a minimum target. 1, pullback 2, maybe. Very tight bull channel, more likely 1, pullback, and then 2. We had this line that we drew in earlier, and it looks like we might be reversing down from that line. And it is a low 2 and a broad bear channel. It is a reasonable short, but because this channel up is so tight, and now we have, 8 bars without a bear bar at this point, that reduces the probability that a reversal down will be successful. It increases the probability that a reversal down will be minor, leading either to a trading range or a bull flag and then another leg up. What do you do? Well, you're in a bear channel, trying to become a bull trend, but it's not entirely clear and we're still forming lower highs. I typically would exit part or all below that bear bar, just in case the bear channel is still in effect. And what about the bears? They see that it's a tight bull channel and that we might get a higher low, maybe a head and shoulders bottom, left shoulder, head, and right shoulder. However, if they're willing to bet on a continued swing down, maybe there's a 40% chance that this will continue down at this point in a bear channel, forming a new low. Bears know the math is okay. Sell below this bar, maybe put a stop just above this bar, and take a chance that we get a new low. If there's a 40% chance of that, there probably is. Their reward is much greater than 2 times their risk, and they have a 40% chance of a profitable swing trade. That math is acceptable, so it makes shorting below that bear inside bar a reasonable trade. Too many lines, so worthwhile removing some lines. Now, we have 2 possible tops. We no longer have a bottom. Yet, we have a major higher low here, a higher low that led to a strong reversal up, and we have another major higher low here, a new low that led to a strong reversal up. It does not have to go to a new high. However, it's a strong reversal up, and at this point, the most logical bear channel line below would be this low and that low right here. New reversals, draw new lines. We might get a parallel channel from here. It's worth considering this as a possible bottom of the channel, as well as this. I think it's okay to put both of those there just in case. For the bears who shorted below that bear bar, this is a good entry bar, a bear bar closing on its low. It was 40% for the bears shorting below this bar, and with this bar looking like this, if they had taken that short, maybe it's 50% chance now that we'll get down to this low. Bears who sell with reversal down from the top of that channel are short. Do I keep this line? Well, we broke above it and we are reversing down. It's probably better to keep using this point and then maybe move the line up to this point, or this point and that point. I would use this point and that point as the new top of the channel until we get more information. And we sold off with good follow through and then a new low. A high 3 pushes up. 1 above this bar, 2 above that bar, and 3 above that bar. And look where we are. We're at the bottom of the channel. It's reasonable for bears to take partial or full profits on the reversal up. You can argue again that it's a possible wedge. 1, 2, and 3. So reasonable to get out above this bar. Aggressive bulls will buy on this reversal up, especially since it's the 3rd reversal up near the bottom of the channel. I want to point something else out. Let's say you're a bull and you bought as the market fell below this low. You bought here, maybe you made a scalp. And you bought here, you made a scalp. We fell below this low, you bought, you made a scalp. Bulls are buying every new low. They buy this low. Some bulls will buy this low, use a wide stop, and scale in lower, knowing that every prior new low led to a profitable trade if you bought the low. Buying below this low, fell below, you made money. Buying below this low, you made money or made money. Buying at this low, you made money or you made money. Buying at this low, you probably will make money. So bulls are buying new lows. That means it's a stair pattern. The pullbacks from the new lows are going high enough up for bulls to make a profit, so they'll continue to buy new lows until they no longer make a profit. When bulls are able to make money consistently like this, repeatedly like this, in a bear trend, that bear trend probably is soon going to evolve into a trading range. Either buy with a limit order at this low, or better, buy above a bull bar on a reversal up, especially since it's the 3rd attempt to reverse up near this low. Bears should get out of their shorts at this point, or at least out of most of their shorts. Aggressive bulls will buy here. Other bulls will wait 2 or 3 bars to see if we start to get a series of bull bars, and then they'll buy. Higher probability, but if they buy up here, their stop is further away, and there's less profit remaining in the trade because they're entering higher up. IOI, we have a bar, an outside bar, and then an inside bar. So this bar is inside this. This bar is inside that. So inside, outside, inside. A type of micro double bottom, a good buy signal bar, a bull bar closing near its high. This is a reasonable buy. Good entry bar for the bulls, very good follow-through bar for the bulls. Big down, big up, big confusion. At a minimum, the market will probably go sideways rather than down. and it might be the start of a bull trend. We have 3 pushes down, 1, 2, 3, didn't quite reach that line, but certainly 1, 2, 3. So some computers see this as a wedge bottom, in which case this could be the end of the bear trend. Good buying pressure, 3 bull bars closing on their highs, and this bar is a better bull bar than this bar, bigger body closing on its high. This bar is better than that bar, bigger bull body closing on its high. So the market is starting to accelerate upward. This might be, in fact, a reversal up from a wedge bottom. At this point, I think the odds slightly favor the bulls. We're always in long. It's more likely that we're going at least a little higher before we go to a new low. Wedge bottom, even though it does not look like a wedge, it's still a wedge bottom. Traders will be looking for 2 legs sideways to up. Leg 1, we don't know, maybe leg 1 ends up here, and then a pullback, and then a second leg. At this point, had you bought above this bull bar, you would put your stop below this low. In fact, a lot of bulls who buy above that bar and get filled right here, they'll immediately put their stop below this low. A third entry buy, they do not want to see the market fall below. This is a type of nested wedge where the third leg is also a wedge. We have a wedge here, 1, 2, 3, and 3 subdivides into a micro wedge, high 1, high 2, high 3, slightly higher probability. Sold off for 4 bars, 3 bear bars, yet reversed up right around this high. You had some scale-in bears who sold this high, sold more higher, and they needed a pullback at least 1 pip below this high to get out with a profit on their second entry, and it looks like they did not get it. This bar represents those limit order bears giving up. So you have bears selling in a bear trend and losing money. Does that sound right? A bear selling in a bear trend losing money? Something's wrong with the premise of a bear trend, and it increases the chances that we'll get at least a second leg up to the top of the channel. The bulls, I do not think they get out below any of these bars, so they hold long, and at this point, a strong enough reversal up. We have 4 bull bars, now 5 bull bars and 6 bars. I think bulls will raise their stop from below here to below here. We have a nested low 2. We have a low 1, pullback, low 2, low 2. So either one of these is a low 2. And the second leg up is also a low 2. Yet it looks like it's failing. So the bears who are selling below this low, below that low, below this low, it looks like they're trapped, just like the limit order bears who sold at this high and scaled in higher are trapped. Now you look at this and say, the bears are losing money and the bears are no longer able to make money. And therefore, those bears have to buy back their shorts. That increases the chances that this trend will continue higher. We're at the top of a reasonable channel, a good location to take partial profits, either with a limit order here. In fact, that's what created this tail, in part. You had bulls taking partial profits there, or you could take partial profits on the low 2 below this bar, or the low 2 below this bar. Low 1, low 2, low 1, or low 2, or low 2. Reasonable to take partial profits, especially when things are not all that clear. We're always in long, but where are the consecutive big bull trend bars that typically happen if this is the start of a big bull trend? They're not present, so this is probably not yet the start of a strong bull trend. And if it's not the start of a strong bull trend and you're at some kind of a resistance level and your reward is at least twice your initial risk, it's reasonable to take some partial profits. Maybe you take some partial profits here. A micro double top, up and then up and down at a resistance level. The top of a channel and a lower high. Just like here was a reasonably strong leg up, we reverse down. You have to be open to the possibility that another strong leg up and we reverse down to another new low. At this point, I think it's more likely that we will not reverse down to a new low and that we'll either stay sideways or continue higher. Okay, we have 6 bars up here with no bear body, and 5 of those 6 bars are bull bars. 3 or 4 of them are closing in their upper half. And the context is good. We have a wedge bottom. The odds are we're going to go at least slightly higher. Is this a strong bull trend? No. Look at all the bars with very prominent tails and small bodies. And bad follow through after this bull breakout. We could not get a strong bull breakout here. We have a decent bull breakout here, but a reversal down here. Bull trend, yes, but it looks more like a bull leg in what will become a trading range. So we have a bear leg in a trading range, the start of a bull leg in a trading range. We have another decent, strong bear bar, and you can argue it's a wedge. 3 pushes up, 1, and then 2, and then 3. So another good location to take profits, maybe below this bear bar. Partial profits, maybe full profits. As far as shorting that goes, When a channel is as tight as this is, it's probably a minor reversal, which means it probably will not fall very far. More likely, it'll fall and form another bull flag for higher prices afterwards. 3 pushes up, 1, 2, 3. A weak rally, lots of dojis and pullbacks, a lot of pullbacks on the way up. Probably a bull leg in a trading range. We broke above this high. Just like bulls were buying every new low on the way down and making money, bears will start selling every new high and willing to scale in higher, expecting to make money on at least a drop big enough for a scalp. You'll have other bears selling below this bar, arguing it's a wedge in a trading range. I think it's a pretty tight bull channel, and I usually don't take that short unless we go sideways and form more of a micro double top. Reasonable location, though, to take partial or full profits. If this is evolving into a trading range, we're in the upper half and we have a wedge rally, and the rally is weak, so it's a good location to take full or partial profits. In a tight channel like this, bulls are buying that low. They're buying with a limit order at that low. They're buying with a limit order this low or that low, betting that all of those bear reversal attempts will fail. They know it's not a strong bull trend, but they know it's a bad sell, and therefore the market will continue sideways or up. I'm now going to draw bull channels, and I will use the E-mini market for examples. Look at this chart. We have a 5-minute E-mini chart, lots of reversals. Every time you see 2 reversals up, you can draw a line. I could draw a line here, and once it breaks below it and reverses up, I move the line here. Once it breaks below it and then reverses up, I can draw a line here and then here. And the same with lines above. We have a reversal down and a reversal down. I would have a line there. We would replace it once we had the breakout. And here we have a reversal down and a reversal down, another possible top of a channel. And I have a reversal down here and then a higher high and a reversal down, another possible top of a channel. So this might be resistance. And then what about this? Reversal down, reversal down. It's possible that this channel may continue all the way up here. Reversal down, a possible top of a channel. And we have a reversal down from there as well. Here, 1, 2, 3, 4, 5. We have 5 bars up, no bear bars. Do you think this is a major reversal, or do you think this is simply a pullback from this bull breakout, a pair of consecutive bull trend bars? It's more likely a pullback from a strong bull breakout. This reversal down probably is not going to go very far. I would rather wait for a second signal. So maybe we go up again and then get a double top. That would be a higher probability short than this. Alternatively, if we start to reverse down strongly, then I'll start selling lower. Right now, at this point, more likely buyers at the low of this bar and lower, and that this will form a bull flag and we'll get at least a little bit more up. And that's what we got, a very strong bull breakout, and the bears are giving up. Not only did we break above this 3-bar bull flag, we broke above this high and above that high. Are computers paying attention to this line right now? No, this line does not help you at this point. You get rid of it. Anytime the market appears to be ignoring a line, get rid of it because it just clutters the chart and it makes it more difficult to see what the market's trying to do. Initially, this line appeared to be unimportant, but we're getting close to it, so the market might see this as a possible top of the channel. Anytime I see any reversal, I'm always drawing lines. And I want to see what the market will do when it gets near those lines. And initially, this line looked much less important than other lines. At this point, those other lines are clearly unimportant, and you have to be wondering, is this the start of a bull channel? Will this be resistance? Will bulls take profits there? Will bears sell there? Possible double top. We reverse down around the same price level. This is a possible double top. We have a neckline down here, but we tried to go down. Instead, we're breaking strongly to the upside. A bull breakout above a double top, 3 pushes up, 1, 2, and 3. If this bull breakout fails, then we'll have 3 pushes up, 1, 2, 3. Whenever you have a double top and a bull breakout that fails, you have 3 pushes up. That is a type of wedge. Also, we tried to reverse down here, and we accelerated upward here. And this is the best looking bull bar in more than 20 bars. It's the best looking bull bar in 60 or 70 bars. Whenever you see that, you have to be thinking that instead of a measuring gap, this might be an exhaustive end of a trend. It could be a second leg trap. So this could be a wedge, bear flag, first leg, and then a second leg, and we reverse down. I'm always thinking about a bear case whenever the market is in a bull trend, because 40% of the time, the bear case will in fact be correct. Different ways to draw lines: reversal down, reversal down, reversal down. I'm always drawing lines, and I want to see what the market does near any of those lines. Will it ignore the line, or will it reverse? Whenever I have a channel with fewer bars, and there's a channel with more bars, the channel with the fewer bars usually is less important, but sometimes it's important. The bigger patterns are usually more important. Clearly an important bull trend line, and I'm always thinking, okay, if the market falls below this line, maybe the bull trend has ended, especially if it falls below this major higher low. A strong breakout to a new high. This is clearly a major higher low. Because it's major and I can draw a line, I'm always going to draw a parallel and connect it to the highest point in between to create a parallel, to see if in fact this is the bottom of the channel and that parallel is the top of the channel. There's the parallel line. Possibly this could be the top of the channel. We don't know what was to the left, but let's say this was the top of a rally. Then this is also a possible top of a bull channel. We have a micro double top, up and then pause, and then up again and then pause. This might be the end of this move up. As I said, it could be a second leg trap. First leg is this wedge, and then very strong breakout and second leg. We're failing above the high of the channel, the top of this blue channel line, and we're failing within 5 bars. We continued up 3 bars and are reversing down. It's a plausible top, not a strong short, but a possible top. You can call it a parabolic wedge, 1, 2, 3, where the third push goes above the top of the line, so it's a parabolic channel. We have a couple things now in favor of the bears. Could be a failed breakout above the top of this trading range. 2 ways to draw the parabolic wedge, either with the green line or the purple line. I'm always looking for other resistance. A very common type of resistance is a measured move target. We had a strong leg up here, and then a pullback, and then a strong breakout. We are just about almost at a perfect measured move up based upon the height of this original leg. So that is also resistance that some computers will use either to take profits on their longs or to go short, and that's what caused this slight reversal down. Bulls might take profits exactly at the line or a tick or two below, or on the reversal down, a micro double top, and many different ways to draw wedges, and a failed breakout above the top of a bull channel, and a failed breakout above the top of a trading range. Low probability short at this point, but reasonable short. So some bears will sell below the low of this bar, or maybe even below the low of this bear bar closing near its low, putting a stop up here, knowing that at this point they might have a 30% chance of a profitable trade, but it could be the top of the move and we could come all the way back down to the bottom of this buy climax, possibly all the way down to the bottom of the trading range. That means that even though their probability is small, their reward is so much bigger than the risk, it's reasonable to take that short. I usually do not take that short. I wait until I see more strength on the part of the bears. But some bears will take that short. It has a positive trader's equation, but a low probability. I like to win most of the time, so I usually do not take low probability trades, even though the math is okay to take a trade like that. And look what we got. We have about 8 bars down here, probably a big enough reversal so that we'll get a second leg down after any bounce. I'm typically selling either at the high of this bar or maybe the second or third consecutive bear close, expecting that we'll get at least a lower high and a second leg down. But it is okay to take that short as well. Where are the targets on the downside? Well, the top of this trading range, you can call it a triangle, 3 pushes down, 1, 2, 3, even though this is slightly below that. You can call it a trading range, and we're testing the top of that trading range. That is support. It was resistance. We sold off at this price repeatedly. We broke strongly above it, and now we're pulling back to it. There will always be some buyers here, bears taking profits and bulls buying. Other targets on the downside are the bottom of this buy climax, or the bottom of this bull leg, or even the bottom of the bull leg here. At this point, I think it looks bullish. 2 legs down, 1 pullback, 2, and the pullback looks much weaker than the rally, and we're forming a higher low, and a breakout test, a pullback to the top of this trading range. high 2 bull flag, 2 legs down, 1 pullback 2. You can call it an ABC pullback, A, B, C, testing the top of the trading range. Tests are rarely perfect. I think of it as a zone, and I'm not surprised if it falls a little bit below those highs. It did not fall strongly below, and we're forming a micro double bottom. We went down, we went up, we went down a little bit, so reasonable to buy, maybe above the high of that bull bar, possibly for a test of this lower high or a test of that high. In any case, these bears will almost certainly take profits above the high of this bull bar because of all the things that I said. A two-legged pullback testing the support at the top of the trading range, and after a very strong reversal up. This is a lot of work. You're constantly drawing lines, you're constantly taking trades. A lot of the trades don't work, you're getting out. No one's going to pay you just for sitting in front of your computer. If you want to make money, you have to do the work, which means you have to be thinking constantly. And you have to be constantly changing your opinion. I use the Forex market to give examples of how to draw lines in bear channels. And then I use the E-mini market on how to draw lines in bull channels. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on channels.